the biggest. But buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business. And I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake, and I would have been way better off taking what I did with Berkshire is I kept buying better businesses. I started an insurance business, Seas, Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Now I've had a lot of fun out of it. I mean, everything in life seems to turn out for the better, so I don't have any complaints about that, but it was a dumb thing to do.
Hi, I'm Howard Winston from Cincinnati, Ohio. First, I wanted to thank you and Charlie for your sharing your time with us today.
Thank you.
My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold...
Do these stocks have names?
Yeah. Well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital because it's always been true. I mean, it was over the years as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, I've got this wonderful thing, and I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Well, I can remember when you bought one membership in some duck club that had oil under it when you were young.
Yeah, there was a company called Atlas.
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlid, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, is that an efficient market or not? $29,000 for $20,000 of cash plus $11,000 of royalty income at 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future.
Yes, hi. Hi, it's Jeff Hull from Toronto, Canada. Mr. Buffett and Mr. Munger, you're both a positive influence on all of us and our generations to come. There were a few significant individuals that had helped to guide your way in the beginning. Could you please share the current percentage of impact and evolution on your investment philosophy and approach between Graham and Dodds versus Phillip Fisher, and comment on each, please?
Charlie, you want to, if you got it worked out there, calibrate?
Warren,
you want that to tenths of a percent or hundredths of a percent? What?
You were closer to Ben Graham.
Yeah, well, Ben, things would have happened, good things would have happened with following either party irrespective of the other. Graham obviously had way more influence on me than Phil. I worked for Ben. I went to school under him. And his, what I call the three basic ideas that underlie successful investing, which is to look at stocks as businesses and to have the proper attitude toward the market and to operate with a margin of safety, they all come straight from Graham. I didn't think of any of those. And Phil Fisher opened my eyes more to the idea of trying to find the wonderful business. Charlie did more of that than Phil did, actually, so you'd have to put Charlie. But Phil was espousing that entirely, and I read his books in the late 50s or early 60s. So, and Phil's still alive, as you know, and I owe Phil a lot, but it doesn't compare to what I owe Graham, and that in no way reflects poorly on Phil. Ben was one of a kind. Sean?
Ben Graham was a truly formidable mind, and he also had a clarity in writing. And we've talked over and over again about the power of a few simple ideas thoroughly assimilated, and that happened with Graham's ideas, which came to me indirectly through Warren, but also some directly from Graham. The interesting thing for me is to watch Buffett, the former protege. And by the way, Buffett was the best student Graham had in 30 years of teaching at Columbia. And but what happened, and since I knew both men, was that Buffett became way better than Graham. That is a natural outcome. It's what Newton said. He said, if I've seen a little farther than other men, it's by standing on the shoulder of giants. And so Warren may have stood on Ben's shoulders, but he ended up seeing farther. And no doubt somebody will come along in due course and do a lot better than we have.
I enjoyed making money more than Ben. I mean, candidly, with Ben, it really was incidental. At least by the time I knew him, it may have been different when he was younger, but it just didn't. The process didn't of the whole game did not interest him more than a dozen other things may have interested him. With me, I just find it interesting, and therefore, I've spent a way higher percentage of my time thinking about investing and thinking about businesses. I probably thought way more about businesses than Ben ever did. He had other things that interested him. So I've pursued the game quite a bit differently than he did, and therefore measuring the record is really, the two records are not. It's not a proper measurement. I mean, he was doing victory laps while I still thought I was out there running against the whole field.
Well, Graham had some blind spots, partly of sort of an ethical professorial nature. He was looking for things to teach that would work for every man, that any intelligent layman could learn and do well. Well, if that's the limitation of what you're looking for, there'll be a lot of reality you won't go into because it's too hard to figure out and too hard to explain. Buffett, if there was money in it, had no such restriction.
Yeah, Ben sort of thought it was cheating if we went out and talked to the management, because he just felt that the person who read his book, living in Pocatello, Idaho, could not go out and meet the management. So he didn't. And we didn't do it. I mean, when I worked for Graham Newman, I don't think I ever visited a management in the 21 months I was there. He wasn't sure whether it'd be useful anyway. But if it was be useful, that meant that his book was not all that was needed, that you had to add something to it. I found it fun to go out and talk about their businesses with people, or to check with competitors or suppliers or customers and all that. But Ben didn't think there was anything wrong with that. He just felt that if he had to do that, then his book was not the complete answer. And he didn't really want to do anything that the reader of his book couldn't do if he was on a desert island, basically with just one line to a broker.
But if you stop to think about it, Graham was trying to play the game of Ken the donkey wearing very dark glasses, and Warren, of course, would use the biggest searchlight he could find.
We still can't find any donkeys these days.
Neil McMahon, New York City, also a Sequoia shareholder. Ben Graham investing encouraged turnover. Looking at Berkshire's holdings, concentration, and long-term, are you still a 15% Phil Fisher and 85% Graham?
I don't know what the percentage would be. I'm 100% Ben Graham in those 3 points I mentioned earlier, and those really count. I was very influenced by Phil Fisher when I first read his 2 books back around 1960 or thereabouts, and I think that they're terrific books. I think Phil is a terrific guy. So I think I probably gave that percentage to, I think I first used it in Forbes one time when Jim Michaels wrote me, and I think it was one of those things I just named a number. But I think I'd rather think of myself as being a sort of 100% Ben Graham and 100% Phil Fisher in the points where they don't, and they really don't contradict each other. It's just that they had a vastly different emphasis. Ben would not have disagreed with the proposition that if you can find a business with a high rate of return on capital that can keep using more capital on that's the best business in the world. And of course he made most of his money out of Geico, which was precisely that sort of business. So he recognized it. It's just that he felt that the other system of buying things that were statistically very cheap and buying a large number of them was an easier policy to apply, and one that was a little more teachable. He would have felt that Phil Fisher's approach was less teachable than his, but his had a more limited value because it was not workable with really large sums of money. At Graham Newman Corp was a closed-end fund. It was technically an open-end fund, but it had $6 million of net worth, and Newman and Graham, the partnership that was affiliated with it, had $6 million. So you had a total pool of $12 million. Well, you could go around buying little machine tool stocks in machine tool companies, whatever it might be, that all statistically cheap, and that was a very good group operation. And if you own a lousy business, you have to sell it at some point. I mean, if you own a group of lousy businesses, you better hope some of them get taken over or something happens. You need turnover. If you own a wonderful business, you don't want turnover, basically. Charlie?
What was interesting to me about the Phil Fisher businesses is that a very great many of them didn't last as wonderful businesses. One of his businesses was Title Insurance and Trust Company, which dominated the state of California. It had the biggest title plant, which was maintained by hand, and it had great fiscal solvency and integrity and so forth. It just dominated a lucrative field. And along came the computer. And now you could create, for a few $1 million, a title plant and keep it up without an army of clerks. And pretty soon we had 20 different title companies, and they would go to great big customers like big lenders and big real estate brokers and pay them outlandish commissions by the standards of yore, and bid away huge blocks of business. And in due course, in the state of California, the aggregate earnings of all the title insurance companies combined went below zero, starting with a virtual monopoly.
So what looked like a monopoly.
Very few companies are so safe that you can just look ahead 20 years. And technology is sometimes your friend and it's sometimes your bitter enemy. If Title Insurance and Trust Company had been smart, they would have looked on that computer, which they saw as a cost reducer, as one of the worst curses that ever came to man.
It probably takes more business experience and insights to some degree to apply Phil Fisher's approach than it does Graham's approach. The only problem is you may be shut out of doing anything for a long time with Ben's approach, and you may have a lot of difficulty in doing it with big money. But if you strictly applied, for example, his working capital test to security, it will work. It just may not work on a very big scale, and there may be periods when you're not doing much. Ben really was more of a teacher than he had no urge to make a lot of money. It did not interest him. So he really wanted something that he thought was teachable as a cornerstone of his philosophy or approach. And he felt you could read his books sitting out here in Omaha and apply buying things that were statistically cheap, and you didn't have to have any special insights about business or consumer behavior or anything of the sort. And I don't think there's any question about that being true, but I also don't think you can manage lots of money in accord with it. Unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. So you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. We could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. We found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I'm not sure that will be a great technique. It may be great if you inherit. Paul Getty inherited the money at the bottom in '32. He didn't inherit it exactly. He talked his mother out of it, but it's true actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. You'll probably learn a lot more with him by coming to this meeting. But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%. And the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened, I mean, we did well back in 1964 because American Express ran into a crook. We did well in 1976 because Geico's managers and auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.
My first question is, Mr. Munger, you are largely credited with moving Warren away from the cigar butt approach to investing as it was practiced by Ben Graham. It's been stated that it was the purchase of See's Candy that taught you this important lesson of buying good businesses. At what point did you realize that this concept of buying good businesses was a better long-term investment strategy, and what was it in your discussions with Warren that allowed you to persuade him to move in that direction? Mr. Buffett, what was it in Mr. Munger's arguments for buying good businesses that persuaded you to abandon the cigar butt approach and move in his direction? My second question is, in both your experience, have you or Mr. Munger ever known of a company that has regained or replaced its competitive advantage once it was lost?
Charlie, do you want to answer the first question about how you...
Yeah, well, I think there's some mythology in this idea that I've been this great enlightener of Warren Buffett. Warren hasn't needed much enlightenment, but we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. Quality, business quality, and so forth. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism constructively is a Well, think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying C's, you can say that Berkshire's been built partly by learning from criticism. Now, we don't want any more today.
Yeah. We also like the peanut brittle, so Charlie is playing it out. I had learned investment and got enormous benefit out of that learning from a fellow who concentrated on the quantitative aspects, Ben Graham, and who didn't dismiss the qualitative aspects, but he said you could make enough money focusing on quantitative aspects, which were a more sure way of going at things and would enable you to identify the cigar butts. He would say that the qualitative is harder to teach, it's harder to write about, it may require more insight than the quantitative, and besides, the quantitative works fine, so why try harder? And on a small scale, there was a very good point to that. But Charlie really did, wasn't just Ira Marshall, but Charlie emphasized the qualitative much more than I did when I started. He had a different background to some extent than I did. I was enormously impressed by a terrific teacher, and for good reason. But it makes more sense, as we pointed out, to buy a wonderful business at a fair price than a fair business at a wonderful price. And we've changed I've changed my focus anyway, and Charlie already had it, over the years in that direction. And then, of course, we have learned by what we've seen. I mean, it's not hard when you've watched businesses for 50 years, to learn a few things about them as to where the big money can be made. Now, you say, when did it happen? It's very interesting on that, because what happens, even when you're getting a new important idea, is that the old ideas are still there. So there's this flickering in and out of things. I mean, there was not a strong, bright red line of demarcation where we went from cigar butts to wonderful companies. But we've moved in that direction, occasionally moved back, because there is money made in cigar butts. But overall, we've kept moving in the direction of better and better companies, and now we've got a collection of wonderful companies.
Could you explain a little more about what you've called the mind of the consumer and the nature of the product, and explain how you actually apply these concepts to find the companies with the growing demand and the best investment potential? And thank you for being two of the greatest professors I've ever had.
Thanks. What you really, when you get into consumer products, you're really interested in finding out or thinking about what is in the mind of how many people throughout the world about a product now and what it's likely to be in their mind 5 or 10 or 20 years from now. Now, virtually every person in the globe, let's get it down to 75% of the people in the globe, have some notion in their mind about Coca Cola. They have, the word Coca Cola means something to them. RC Cola doesn't mean anything to virtually anyone in the world, but does with the guy who owns RC, but and the bottler, but everybody has something in their mind about Coca Cola, and overwhelmingly it's favorable. It's associated with pleasant experiences. Now, part of that is by design. I mean, it is where you are happy. It is at Disneyland, at Disney World, and it's at ballparks, and it's every place that you're likely to have a smile on your face, including the Berkshire Hathaway meeting, I might add. And that position in the mind is pretty firmly established, and it's established in close to 200 countries around the world with people. A year from now, it will be established in more minds, and it will have a slightly different overall position. And 10 years from now, the position can move just a little bit more. It's share of mind. It's not share of market. It's share of mind that counts. Disney, same way. Disney means something to billions of people. And if you're a parent with a couple of young children and you got 50 videos in front of you that you can buy, you're not going to sit down and preview an hour and a half of each video before deciding what one to stick in front of your kids
you have got something in your mind about Disney, and you don't have it about the ABC video company, or you don't even have it about you don't have it about 20th Century, or you don't have it about Paramount. So that name, to billions of people, including lots of people outside this country, it has a meaning. And that meaning overwhelmingly is favorable. It's reinforced by the other activities of the company. And just think of what somebody would pay if they could actually buy that share of mind, of billions of people around the world. You can't do it. You can't do it by $1 billion advertising budget or a $3 billion advertising budget or hiring 20,000 super salesmen. So you've got that. Now, the question is, what does that stand for 5 or 10 or 20 years from now? There'll be more people. There'll be more people that have heard of Disney. And that there will always be parents that are interested in having something for their kids to do, and that kids will love the same sort of things. And that whoops. He emphasizes the key points when we get to those. But that is what you're trying to think about with the consumption product. That's what Charlie and I were thinking about when we bought See's Candy. I mean, here we were in 1972. We think we know a fair amount about candy. I know more than when I sat down this morning. I mean, I had about 20 pieces already. But, does their face light up on Valentine's Day, when you hand them a box of candy and say, it's some nondescript thing, and say, here, honey, I took the low bid, or something of the sort. And no, I mean, you want something, you've got tens of millions of people, or at least many millions of people that remember that the first time they handed that box of candy, it wasn't that much thereafter that they got kissed for the first time or something. So it's the memories are good, the association's good. Total process isn't just the candy; it's the person who takes care of you at Christmas time when they've been on their feet for 8 hours and people have been yelling at them because they've been in line with 50 people in line, and that person still smiles at them. The delivery process. It's the shop in which they get all kinds of things. The treat we give them, it's all part of the marketing personality. But that position in the mind is what counts with a consumer product. And that means you have a good product, very good product. It means you may need tons of infrastructure because you got to have that. I had a case of cherry Coke awaiting me at the top of the Great Wall when I got there in China. Now that you've got to have something there so that the product is there when people want it. And that happened in World War II. General Eisenhower, said to Mr. Woodruff that he wanted a Coca Cola within arm's length of every American serviceman in the world, and they built a lot of bottling plants to take care of that. That sort of positioning.
My name is Jim Rickards. I'm a former advisor to the CIA, Department of Defense, and the White House. In a moment, you'll have my own evidence that very few people have seen. You'll see how I believe 2 acts of democratic stupidity are about to combine into a storm that will change America forever, the American Energy Armageddon. In fact, due to specific circumstances created by
can be incredible. It seems to work especially well for American products. I mean, people want positioning can be incredible. It seems to work especially well for American products. I mean, people want certain types of American products worldwide. Our music, our movies, our soft drinks, our fast food. You can't imagine, at least I can't, a French firm or a German firm or a Japanese firm having that selling 47 or 48% of the world's soft drinks. I mean, it just doesn't. It doesn't happen that way. It's part of something you could broadly call an American culture, and the world hungers for it. And Kodak, for example, probably does not have quite the same. George Fisher's doing a great job with the company. This goes back before that. But Kodak probably does not have the same place in people's mind worldwide quite as it had 20 years ago. I mean, people didn't think of Fuji in those days, we'll say, as being in quite the same place. And then Fuji took the Olympics, as I remember, in Los Angeles, and they pushed their way to more of a parity with the Kodak. And you don't want to ever let them do that. And that's why you can see a Coca Cola or a Disney or companies like that doing things that you think, well, this doesn't make a hell of a lot of sense. If they didn't spend this $10 million, wouldn't they still sell as much Coca Cola? But that I quoted from that 1896 report of Coca Cola and the promotion they were doing back then to spread the word. You never know which dollar is doing it, but you do know that everybody in the world that's virtually has heard of your product. Overwhelmingly, they've got a favorable impression on them, and the next generation is going to get it. So that's what you're doing with consumer products. With See's Candy, we are no better. We want to no better than the last person who's been served their candy with the last product they've been served. But as long as we do the job on that, people can't catch us. We can charge a little more for it because people are not interested in taking the low bid, and they're not interested in saving a penny a bottle on colas. Remember, we've talked about in these meetings private labels in the past, and private label is stalled out in the soft drink business. That they want the real thing, and 900 and some odd million 8-ounce servings will be served today of Coca Cola product around the world. 900 million, and it'll go up next year, the year after. And I don't know how you displace companies like that. I mean, if you gave me $100 billion, and I encourage any of you who are thinking about that to step forward, but if you gave, and you told me to displace the Coca-Cola company as the leader in the world in soft drinks, I wouldn't have the faintest idea how to do it. Those are the kind of businesses we like. Charlie?
Yeah. I think the See's Candy example has an interesting teaching lesson for all of us. Warren said it's the first time we really stepped up for brand quality, and it was a very hard jump for us who had been used to buying dollar bills for 50 cents. And the interesting thing was that if they had demanded an extra $100,000 for the See's Candy Company, we wouldn't have bought it. And that was after Warren had been trained under the greatest professor of his era and had worked 90 hours a week.
And eating a lot of chocolates, too.
Absorbing everything in the world. I mean, we just didn't have minds well enough trained to make an easy decision right. And by accident, they didn't ask the extra $100,000 for it, and we did buy it. And as it succeeded, we kept learning. I think that shows that the name of the game is continuing to learn. And even if you're very well trained and have some natural aptitude, you still need to keep learning. And that brings along the delicate problem. People sometimes talk about two aging executives. I don't know what the hell that means as an adjective, because I don't know anybody that is going in the other direction. But you people who hold shares are betting for a while at least until younger successors come along. You're betting to some extent on what we'll now tactfully continue to call aging executives continuing to learn.
If we hadn't bought See's with some subsequent developments after that, because that made us aware of other things, we wouldn't have bought Coca Cola in 1988. I mean, you can give See's a significant part of the credit for the, I guess, $11 billion plus profit we've got in Coca Cola at the present time. Now you say, well, how could you be so dumb as not to be able to recognize a Coca Cola? Well, I don't know, but
you're only drinking about 20 cans.
Yeah,
a day,
right. It wasn't I hadn't been exposed to it, it's amazing. But it just made us start thinking more. We saw how decisions we made in relation to See's played out in a marketplace and that sort of thing, and we saw what worked and didn't work, and it made us appreciate a lot what did work and shy away from things that didn't work. But it definitely led to a Coca-Cola, and we've had the good luck to buy some businesses themselves in their entirety that taught us a lot. We bought, and it's worked in the other direction. I mean, we were in the windmill business one time. I was. Charlie stayed out of the windmill business, but I was in the windmill business and pumps and third level department or second level department stores, and I just found out how tough it was and how you could apply all kinds of energy to them, and it didn't do any good. It made a great deal of sense to figure out what pond to jump in, and what pond you jumped in was probably more important than how well you could swim. Charlie?
I don't think it's necessary that people be as ignorant as we were, as long as we were.